Welcome to the High Yield Real Estate Investing Podcast, a podcast focusing on multifamily investing in short, easy-to-digest 5-minute segments.
Hi, I'm Brooke.
And I'm Dan.
Hey, Dan. Let's talk about all the tax advantages that we get with investing in multifamily real estate.
Disclaimer, we're not CPAs. We are not certified financial professionals by any means. This is definitely not tax advice.
So, if you're a higher income earner, can you reduce your current tax obligation by investing in real estate? Not really. But you can increase your income without increasing your tax burden. Real estate is tax advantaged. The government gives you a tax break for participating in the activity. Why would they do that? Well, they want to encourage the activity since the private sector can accomplish it more efficiently than the government. This is how the government encourages certain behaviors within the private sector. Tax breaks are incentives. A few examples include starting a business, employing people, exploratory drilling, farming pistachios. Yep. So let's talk about all these different types of tax advantages that we can get. Number one is depreciation. The IRS allows us to account for this asset's wear and tear during normal, regular use and make any deductions from the passive income to allow that. We can depreciate the cost basis of the residential property over 27 and a half years and commercial property for 39 years. Also, we can depreciate certain improvements we make to the property. Install a new HVAC system, put in new windows. Hey, we can depreciate those as well instead of just counting them as an expense in the taxable year that they occurred. These will add to the cost basis of the building. Number two, accelerated depreciation. The IRS allows us to depreciate certain items faster than the straight line 27 and a half or 39-year appreciation. Certain improvements or personal property can be depreciated on a 5, 7, or 15-year timeline. For that, we need to order a cost segregation analysis. Utilizing that service allows us to reduce our tax liability and taxable income. Number three, bonus depreciation. The laws on this have just changed in 2017. In some cases, we're now able to depreciate 100% of the cost basis of certain items in the year that they were placed in service. A cost segregation analysis will outline what can be depreciated on what timeline. However, if you just own a single-family home or two, the cost of the study will probably negate the benefit of any tax advantage since they cost themselves about $4,000 to $8,000 each, more or less. It depends, of course, on the location of the properties, whether they're all in the same city or not, or different areas. These cost segregation analyses are typically used, therefore, on larger, more expensive properties like multifamily, apartment complexes, and commercial properties.
There's also this new thing called opportunity zones. If you've clicked through real estate listings for any length of time over the past 2 years, you're bound to come across listings advertising, even screaming that their property is in an opportunity zone. Again, this is the government trying to encourage an activity by giving a tax break for it. Specifically, they're trying to encourage capital investment in distressed areas. However, in order to take advantage of this, you have to invest more into the building than it costs to purchase it and do that within 30 months of purchase. If you meet that threshold and hold the investment for at least 5 years, you can get a discount on your capital gains tax liability by 10%. You can defer more if you hold for longer.
Next, there's a 1031 exchange. You can defer your capital gains tax when you sell your property by buying another property of equal or greater value than the one that you sold. Sounds pretty awesome, right? Theoretically, you can defer these taxes indefinitely if you keep scaling up to larger and larger properties, but you still need to meet some requirements. You have to solicit the services of a 1031 intermediary, identify the future property you want to buy within 45 days, and close on that property within 180 days from selling your exchange property. Also, the taxable entity that sells the property for exchange must be exactly the same as the one that buys the subsequent property.
Let's talk about passive gains and losses. More than likely, you'll pay no or very little tax on your income derived from real estate. Now, whether you own it directly or invest with a partner in a syndication for the first few years, if you have a positive net income after accounting for depreciation from your real activity, you'll owe some tax at your marginal tax rate. However, if you show a passive loss, then any losses from real estate won't carry over to your earned income, unfortunately. However, you do get to carry forward those passive losses for many years. Now, the only way for your passive losses from real estate to offset the tax you owe from your earned income is to be classified as a real estate professional, which we won't get into.
So why does everyone say real estate is great for your taxes if you can't reduce your earned income from investing in it? Well, that's because we can increase our income over time while paying little or no tax. If you continue acquiring real estate, theoretically, you can replace your income from your W-2 job and pay far less tax as a result.